Now speaking, Christiane Peltz, Vice President, Investor Relations. Joel Anderson, President and CEO of Five Below, opened the company's first quarter 2023 earnings call by welcoming everyone and reminding them that certain comments made during the call may constitute forward-looking statements. Anderson noted that such statements are subject to known and unknown risks that could cause actual results to differ materially from those mentioned. Anderson then confirmed that Five Below does not undertake any obligation to update their forward-looking statements. Management then invited questions from the audience. Now speaking, Joel Anderson, President and Chief Executive Officer. Five Below had a successful first quarter in 2023 with sales growth of approximately 14% to $726 million and a transaction-driven 2.7 comp sales increase, despite the challenging economic environment. Transaction increases were the highest since 2017 excluding the stimulus-fueled period during the pandemic. The company is a trend-right extreme value retailer, offering customers wow products at amazing values. Products in high demand included Squish, Hello Kitty, anime, collectibles, candy, snacks, beverages, beauty items, accessories, Super Mario movie-related merchandise, and Easter baskets and candy. Five Below plans to reach a milestone of over 200 new stores this year, while building its pipeline for next year and beyond. It has converted 250 stores into the new prototype in the first quarter alone and is on track to convert over 400 stores this year. Five Below also opened its first global sourcing office in India and is investing in digital marketing to increase brand awareness. Furthermore, it is optimizing inventory forecasting, ordering, replenishment, and flow, as well as hiring and training hundreds of thousands of crew members. For Q2, the company expects a continuation of transaction increases, and it believes many of the headwinds of the pandemic era will begin to emerge as tailwinds. Now speaking, Ken Bull, Chief Operating Officer, Chief Financial Officer, and Treasurer. Summary. In the first quarter of 2023, total sales increased 13.5% to $726.2 million from $639.6 million reported in the first quarter of 2022. Comparable store sales increased by 2.7%, with a comp transaction increase of 3.9%, partially offset by a comp ticket decline of 1.2%. 27 new stores were opened across 19 states, and at the end of the quarter there were 1,367 stores, an increase of 142 stores or approximately 12%, versus 1,225 stores at the end of the first quarter of 2022. Gross profit for the first quarter of 2023 increased 13.6% to $234.8 million. SG&A as a percentage of sales for the first quarter of 2023 increased approximately 80 basis points to 26.5%. Operating margin decreased approximately 80 basis points to 5.8%. Net interest income was $3.65 million and effective tax rate for the first quarter of 2023 was 18.6%. Net income for the first quarter of 2023 was $37.5 million and earnings per diluted share for the first quarter was 67 cents. For the second quarter of 2023, net sales are expected to be in the range of $755 million to $765 million, an increase of 12.9% to 14.4%, with a comparable sales increase in the range of 2% to 3%. Operating margin of 7.5% to 7.9% is expected, or deleverage of approximately 70 basis points at the midpoint. Net interest income is expected to be approximately $4 million, taxes are expected to be approximately 26%, and diluted earnings per share for the second quarter of fiscal 2023 are expected to be 80 cents to 85 cents. For the full year, sales are expected to be in the range of $3.5 billion to $3.57 billion, an increase of 13.8% to 16.1%. Comparable sales increase is expected to be in the range of 1% to 3% and operating margin is expected to show slight expansion at the midpoint of guidance. Diluted earnings per share are expected to be in the range of $5.31 to $5.71, implying year-over-year growth of 13.2% to 21.7%. Morgan Stanley analyst Simeon Gutman inquired, "Can you provide insight into your quarter and the cadence of it, particularly in terms of how your customers are handling basket pressure and visits?" Joel Anderson replied, "Thanks, Simeon. It looks like our customer base is rebalancing their spending habits, which we have seen in the strong transaction-led quarter. Easter was good for us and post-Easter was softening, but that's typical with customers buying closer to events. We're seeing a return to pre-pandemic trends and continue to benefit from end-of-month cycles. Our extreme value proposition stands strong in both tough and prosperous times. We believe the last thing customers cut out are their kids. We've seen an improvement and believe the headwinds have peaked." Truist Securities analyst Scott Ciccarelli inquired, what point would you expect average ticket to turn positive, given the current environment and Five Beyond's growth? Joel Anderson replied, thanks, Scott. We've seen some declines, but they're small compared to the post-pandemic increases in ticket sales, which remain double-digit higher than pre-pandemic figures. Our customers are being selective about what they purchase, but we're seeing positive trends in trip transactions, more reasons for customers to visit Five Below. Anything else to add, Ken? Ken Bull replied, no, you nailed it, Scott. We noticed early on that our store was driving an increase in transactions due to its newness. It's still early days, but we're seeing a transaction increase versus tickets so far. J.P. Morgan Chase & Company analyst Matt Boss inquired, Joel, could you discuss the broad-based performance and the drivers behind the material improvement in transaction count? Ken, what were the results of the new builds and the acceleration decisions for new stores and conversions? Joel Anderson replied, yes, 7 out of our 8 worlds performed well and provided positive comps, with the exception of tech. We saw particularly strong growth in consumables, candy, snack, beverages, and HBA. This indicates that customers are taking advantage of our full offering. Ken Bull replied, it's full store. We're happy to see our store productivity return to the 90-plus range in recent quarters, with a couple of stores hitting records this spring. Our guidance suggests continued performance at this level as we move through the year. Roth MKM analyst David Bellinger inquired, Joel, what are your plans for the recently acquired leases with larger store footprints? Are you considering a larger store format and an expanded product selection including Five Beyond? Joel Anderson replied, thanks, David. We picked up the majority of stores on Tuesday morning and the exact number is immaterial to us. Our original Five Below prototype was only 4,000 to 5,000 square feet, but we've grown it close to 10 now with our Five Beyond concept. We can keep growing this by pushing back the back wall and creating new classifications. For the next couple of years though, we're focused on converting to the current prototype. Craig-Hallum Capital Group analyst Jack Cole inquired, could you please comment on any impacts of shrinkage in the quarter and quantify it in terms of basis points? Joel Anderson replied, shrink is a major factor in retail, and we are not immune. We saw the impact of this in our fourth quarter last year. We have taken steps to reduce shrink in our business, such as changing our return policy. Do you have any other questions about shrink? Ken Bull replied, no, Jack, as Joel stated, we're prioritizing preventive steps to reduce shrink. We have not seen a material difference from our physical inventories at the end of last year. Our guidance for this year reflects the higher rate from last year's inventories. UBS analyst Atul Maswari inquired, are Five Beyond remodels still providing a mid-single-digit lift, and is there any risk of moderation due to macroeconomic conditions? Joel Anderson replied, thank you for your question. We've seen a consistent lift in performance and customer satisfaction since the conversion to Five Beyond. The mid-single-digit forecast remains unchanged as we see the continued success of this change. Guggenheim Partners analyst John Heinbockel inquired, Joel, could you comment on the acceleration of Five Beyond conversions and your thoughts on the tech world reset? Are these changes likely to move us back into positive territory? Joel Anderson replied, thanks, John. We could technically accelerate conversions, however we chose to front-load them this year due to the record number of new stores opening in the back half. Our team is planning to wrap up conversions by the end of Q2 so they can focus on those new stores. As far as Tech World goes, we have seen some improvement in an even bigger reset coming early this fall that may be beneficial due to Apple's release. You should start to really see the improvements in the second half of Q3 and fourth quarter. Wells Fargo Securities analyst Edward Kelly inquired, can you provide clarity on the expected cadence of comps for the rest of the year? Additionally, what product initiatives are you most excited about for the holiday season? Joel Anderson replied, Ed, regarding our comp sales growth, when looking at the 4-year CAGR, the first half of this year is in line with the second half. Our forecast for Q2 has midpoint aligning with what we saw in Q1. As for the back half of the year, we are encouraged by the trends and opportunities we see, but at this time, we'd like to keep that information closer. Thank you. Bank of America Merrill Lynch analyst Jason Haas inquired, can you provide an update on the 2Q comp count versus May? What are the compares like through the quarter? Ken Bull replied, thanks, Jason. Normally, we don't provide intra-quarter activity, but when preparing our guidance for this quarter, we consider our current position and if there are any changes in the business, expectations, or anomalies compared to last year. Our guidance of 2 to 3 remains relatively consistent with what happened last year, potentially a slight deceleration due to customer and inflation-related factors. Joel Anderson replied, Q2 last year saw relatively consistent performance across all months. Oppenheimer and Company analyst Brian Nagel inquired, what is behind the 1-point reduction in the annual comp guidance? Is it a current expectation or something more mechanical? Ken Bull replied, in response to the question, I can say that we previously provided a comp guidance of 1% to 4%, which we have since narrowed to 1% to 3%. Our full-year comp guidance assumes performance in the first half of the year, with second-half comps in the low single digits. We expect the low end would assume some deterioration in the macro consumer environment, and the high end would see slight acceleration in tailwinds such as increased conversions and more effective marketing. Goldman Sachs analyst Kate McShane inquired, can you quantify the impact of consumers trading down or shopping at Five Below in the first quarter? Joel Anderson replied, thanks for your question, Kate. We haven't seen anything significant in terms of trade down yet. Our core customers remain loyal and continue to spend with us, even increasing their discretionary spending. However, we have seen an overall increase in transactions. Credit Suisse analyst Dan Silverstein inquired, can you provide insight into the transaction growth, specifically in terms of contribution from new customers and existing customers shopping more frequently? Additionally, what are your plans for margins in 3Q versus 4Q? Joel Anderson replied, that one? We are seeing a positive impact on our transactions from both new and existing customers. Our margins have improved as a result, which is very encouraging. Ken will expand on those details. Ken Bull replied, in Q2, we expect to see a 70 basis point deleverage in operating margin. However, we anticipate the back half of the year to show an operating margin leverage. In particular, Q4 should show a gross margin leverage of more than 150 basis points, with SG&A deleverage slightly less at around 150 basis points. Citi analyst Kelly Crago inquired, get a better handle on the size of that business for us? What is the size of your licensing business today compared to pre-COVID and peak levels, and what upcoming developments have you got planned? Citi analyst Kelly Crago inquired, could you provide any insight into the projected differences in comp sales between the third and fourth quarters? Thank you. Joel Anderson replied, Kelly, the license revenue for the past 3 years has been minimal due to the lack of movie releases since COVID-19. Super Mario did surprise us, but it was not a material impact on our business. We have hoped that some of the movies coming out this year will turn into licenses, and if they do, we'll certainly take advantage of them. As far as back half guidance, Ken Bull replied, Kelly, we are expecting low single-digit positive comp in both Q3 and Q4. We anticipate leverage in operating margin for both quarters, with slightly more leverage expected in Q4. Exane BNP Paribas analyst Steve McManus inquired, can you provide insight into any shifts in gross margin due to changes in consumables? Joel Anderson replied, overall, we've seen a shift in trends over the past year. We are always monitoring and chasing these trends, but the changes have not been material or drastic. We haven't experienced any shifts of more than 1,000 basis points. Gordon Haskett Research Advisors analyst Chuck Grom inquired, hey Joel, what have you learned so far about tokenization and when do you plan to implement a loyalty program? Joel Anderson replied, thanks, Chuck. We have now firmly implemented tokenization and are ready to start exploring loyalty programs as the next logical step. We had to put some of this on hold due to COVID, supply chain, and inflation issues that the teams were dealing with. But we've laid the groundwork and will be looking to put the loyalty program in place in 25 rather than 24. We'll keep you all updated as we move forward. Deutsche Bank analyst Christina Katai inquired, can you share how the data analytical work you are doing is helping strengthen your merchandising and pricing strategies? Specifically, with regards to candy, snacks, and HBA, what opportunities have you identified to further capitalize in this current consumer environment? Joel Anderson replied, thanks, Christina. We've been focused on delivering value since the start, and our commitment to that shows in our 16-foot wall of products priced at $1, $3. This resonates with customers and we know it's a key part of what makes us special. Candy and snacks are a big part of this, but there's much more. Our $1, $3 range has something for everyone and really shows the value we offer. Joel Anderson replied, thank you for joining us today. As I mentioned in my closing remarks, Five Below is on the offensive this year with 200-plus store openings, 400-plus conversions and a robust supply chain. Looking ahead to 2024, our growth prospects remain strong. I invite you all to visit our stores to experience all the summer fun we have to offer. Have a great night.